All right, welcome to Catalysts. I am Myles Udland in for Madison Mills. We're about 30 minutes into the U.S. trading day. Let's take a look at where we are and get three catalysts we're watching in this hour. First up, dip buyers return amid an uncertain outlook, but has the worst of the sell-off already hit stocks? We'll discuss. Plus, President Trump's reciprocal tariff deadline looms. We break down what it means for investors and the economy. And speaking of tariffs, what's the view from the Federal Reserve as Jay Powell revives the central bank's use of the word transitory? We will discuss. All right, half an hour into the start of U.S. trading, let's get a check of the markets brought to you by Tasty Trade. Taking a look at the major averages, we see the Dow off about 1%, the most among the majors, off about 400 points. S&P 500 off 0.8. The NASDAQ down about 0.7%. So seeing a little bit of weakness into the final trading day of this week, a week that overall has been a little bit more constructive than what we've seen over the last few weeks. But since those February 19th highs, S&P entering correction last week and still struggling for direction, struggling to find firm footing here for the major averages. All right, let's take a look at what's happening over in the bond market. We take a look here at yields coming in a little bit. 10 years sitting at 4.2%, 4.55% on the long bond. 5 years just under 4%. We continue to see, again, for the bond bulls, a little bit more constructive there, but with yields sitting above 4%. We saw that mortgage rates number yesterday. A little bit of relief, not a ton of relief for folks out there in the housing market, about 6.7 on the 30-year fix. Finally, let's take a look at Bitcoin this morning, 83,000. Again, Bitcoin coming off those record highs in a better position than we've seen. We saw Bitcoin under 80,000 at various points over the last couple of weeks, down 2% today, 83,000. I think, again, floating in space here, let's say, for Bitcoin, looking to figure out what the next move is. You got the overhead at about 100 or so. Underneath, you're looking at 70, and we're in the battleground right in between. We'll see how that evolves over the weekend, where that market will remain open. All right, I want to welcome in Jay Woods. He's a friend of the show, global strategist at Freedom Capital Markets. He'll be with us for the hour. So, Jay, let's just start talking about what we've seen in the markets really over the last 3 weeks. Last month, we're now a little over a month away from those record highs, the February 19th record highs. And we were chatting a little bit before we came on about, where are the dip buyers? What kind of market environment are we in? Have you moved on from the idea that this is a buy the dip market and that we're in a new environment for investors who are reading these things every day, trying to figure out what's the marginal move to make under these conditions?
Yeah, so much to digest there, but that's what the market is doing. It's in a digestion phase. We got our correction. We got that 10% move down, so we can check that off the scorecard and things that normally happen in bull market cycles. And what's leading us down? Discretionary and tech, not exactly what you want to see taking us down. Semiconductors are in a bear market, down 20%. And we're going to talk about some of the other individual stocks within there that are in bear market territory. But overall, the dip buyers, they've kind of pulled off to the sideline. We are watching headline to headline to headline. And when didn't we have headlines? We didn't get any headlines out of Washington last Friday. We didn't get any out of Washington last Monday. And guess what? We did. We rallied. Then it was Jay Powell. All right. I think he struck a right tone with everybody. We've kind of stabilized a little bit. And now we wait for what? April 2nd. We do have PCE data next week, but I think we're in this zone where people are a little skittish. And what do they do when they're skittish? They sell first, they stay to the sidelines, they wait. So let's see, and then you can break it down sector by sector. Leadership, it's not the leadership you want in a cyclical bull market, but right now the leadership is pausing, and you got to watch these stocks carefully.
So, an average year, you see the S&P 14% down from peak to trough. So we're well within that normal range. You mentioned the cyclical bull notion, and I think it really became consensus on the street, I think is fair, that we entered a new cyclical bull, October of 22. To me, it feels like one correction we can't talk about being out of that. But what are you thinking about in that sort of context? Are you thinking about year 3 of the bull usually does this? These are the sectors I want to see acting better? Are you almost comfortable with watching a bear market hit the S&P and still thinking we're in that cyclical bull?
No, you don't want to go full bear market. I'm still one of these cyclical bulls thinking, yes, this is the digestion phase, that sideways year where we, don't go up 20%. Okay, we've had 2 great years, so we're flat.
Easy.
We're flat. We're down a little bit. Yeah, it's not going to be nice looking at your 401k. You're going to be a little bummed. But these are normal cycles we see. We're still seeing rotation underneath the surface. Energy is the leading sector right now, but we've seen staples catch a bid. Some of these defensive names. That is normal market behavior. But you want to see the generals get back to the front and lead this market, and we're not seeing it. So we've got to watch some interesting data coming first. And what is the one thing mentioned in every single conference call? It's tariffs. And we won't know for certainty. Market's not getting any certainty. We're seeing it from Nike today. We're seeing it from FedEx. If you're not able to guide because you're uncertain what the future is, and hopefully we get a little better clue from that come April 2nd, and then these CEOs can adjust, and that forward guidance can be a little more optimistic than clouded as it's been right now.
So you mentioned transitory, and I'm curious what your view was, talking to your contacts, your traders that you know. When Powell came out and said it on Wednesday, especially, and then he was pressed on, why are you saying this? Last time, the market, as you mentioned, was okay with it, but I'm still 2 days later kind of surprised. He was like, that's the base case.
That was a jaw-dropping moment for people that follow Jay Powell. Transitory was the one thing you never thought would come back. He used it when talking about tariffs and talking about this phase of inflation we may go into, but choice of words was very interesting. But what I thought Jay Powell did right is he struck the tone and he talked about the big picture and, hard data versus soft data. And the soft data being, surveys and consumer sentiment versus, inflationary data like the CPI, the PCE next week. It's still at a historically good level where they don't have to panic and do anything right now. If the data can continue to stay where it is, they're showing the dot plot shows 2 cuts. So to me, that was what the focus was. But when you heard transitory, all of us on the trading floor were like, what? He didn't just go there. But what he did was he kind of avoided any controversy, and he set the stage. He basically handed the ball to Washington and said, here you go, President Trump. If you're going to make this market go down, you're going to do it on April 2nd or beforehand with some crazy headline.
Listen, he's 8 years into the job. It's not his first time trying to negotiate this. Something, before we move on, something I want to ask about is, you're looking at, kind of let's say the marginal bid in the market, which I'm always referencing, and I think it's kind of a squishy concept. But in this specific moment, how you're thinking about the role that retail plays or doesn't play in the market, and what really is like culturally, I'd say culturally buy the dip. You lose your parlay last night, you can load up on 3 more tomorrow. We'll talk about that when we get all set.
Exactly. 12 noon today.
Only a couple hours till we can all go do that. But how you think about that bid, the role that investor plays in the market now, because in 18, it was a different sort of setup dealing with tariffs. The pandemic really changed, I think, how we're going to view retail traders forever, or at least the rest of our careers. So I'm curious how you look at it today, knowing that institutions are nervous, people need to degross. They were too long and stuff, and investors are like, I wasn't long enough Nvidia. I need to come in at this level and buy with 2 hands.
I know. Well, the retail trader is a momentum trader. And right now they're just kind of like, we've gotten burned. We bought the dip, it didn't work. We bought the dip, it didn't work. One of these times it's going to work. And that's why as a technician, you know your levels, as Jared's going to show us some levels in a little bit. But the retail trader right now is kind of skittish. It's just like the regular, just every human watching the news. Like, oh my God, what did he say now? What happened here? So when there's angst, when there's a little nervousness, people do rush out. And you look at those momentum trades. Palantir is the perfect example. AppLovin, another great example. Stocks that just went up and everyone had to be in it, and then all of a sudden they failed. They're getting to viable levels, tradable levels, at least for a bounce perspective. So I don't think the retail investor is done with this market, but I think they're actually smart. They're waiting on the sidelines, waiting for a little certainty, which is what we all kind of want.
I guess when you look at an average chart, just to go on the Palantir point, just very quickly, it's like, does that chart look the way it does now because the retail bid, and it may not have looked that way, 5-10 years ago?
No, we see cycles like this all the time, but so you don't know what the next Palantir is going to be. But for me, Palantir had great earnings. They blew it out of the water. It gaps as a technician, fantastic. And then it got a little carried away. And then when it pulled back, people just got fearful. They just got out, and they're reassessing the situation now. So we're probably another quarter earnings away before things start to settle, and we wait for the guide. So tariff resolution, hopefully, who knows if that's going to happen. And then these CEOs can get back to work and say, okay, this is how we're going to adjust, this is how we're going to adapt, and this is how we can guide going forward. But when they give guidance that's unclear, that's not a signal to just rush into stocks. That's why you don't see stocks with the momentum, with the retail base jumping into them.
All right, we'll leave it there. Great environment, a different kind of environment, I guess, to deal with for investors. All right, Jay Woods, stick with us. We'll have all your market action ahead. Stay tuned. You're watching Catalysts.
The U.S. dollar has been under pressure all year, and lately stocks have joined the greenback to the downside as investors try to price in President Trump's tariff policies. I'm Jared Blikre, host of Stocks in Translation. Let's take a look at the greenback here. This is going to be the dollar. There's some interesting things going on. Typically, the dollar moves opposite stocks, but not always. And Goldman Sachs just did an analysis, and what we're looking at here is the dollar gains and loss during different stock market corrections. And right here on the right, we have the fastest one on history. So these are the top 10 fastest corrections. And what you're going to see here, this is a dollar reaction. That was to the downside. Here's where we are right now. That is another reaction to the downside. There's one in November 74. But you can see this is an historical anomaly. And here's another list that kind of exemplifies the same thing. There's a lot of data here, but I want you to come away with one takeaway that is very unusual for the dollar and equities to be going in the same direction, especially to the downside for any length of time. Here we see that is a present situation. It's been happening for 1.5 months, and this goes back to the beginning of the century. So we saw it a couple times in the wake of the dot-com bust. We saw it a couple times around the global financial crisis, and then around the U.S. debt crisis downgrade in 2011. So you wrap all that together, some interesting things happening. And I want to plot some of the correlations that I've been watching recently. This is a year-to-date chart of the Invesco U.S. dollar ETF, UUP. That's a good dollar proxy. And here we have the Spider S&P 500 ETF, SPY. And what we're seeing here, they have definitely been going in the same direction, which is down for a little bit of time here. And even if I put on a one-year chart, there is another instance of this that happened around the election last year, actually started a little bit before, where both of them were going up at the same time. There's a number of reasons why they could be doing this. Sometimes the dollar goes up because it's in the best position of the world and everything's growing and the U.S. is a leader. Other times the things are going badly and people are flocking into the dollar, and those are haven flows. And sometimes, and maybe that's now, the U.S. is just not the leader in the world anymore, and we're dragging a little bit. I want to go back here and just show you the seasonality for the U.S. dollar index, and that is something that is turning bullish right now. So if you've been keeping track of these episodes of this segment here, we turned bullish on Apple yesterday, we turned bullish on stocks in general over the last week, and now we're getting a bullish seasonality call in the US dollar index. So this shows the entire year. The white line is what happens on a median basis going back all the way to 1971 in the US dollar index. And in green, we have what's happened so far this year. It's kind of tracked, and you can see we've inflected up a little bit. And this is coinciding nicely with this rise that we should, in theory, have into early April. But you can see from there, we get a little bit of pressure, and it's not really until later in the year that we get this big updraft, historically speaking, in the dollar. So all told, it looks like there's some bullish things lining up with both the dollar and the stocks. And yes, it's unusual, but yes, it can happen as well. So tune into Stocks in Translation for more market decoding deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared Blikre, thanks as always. All right, now it's time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. All right, first up, a name we can't get enough of is GTC conference wrapping up today. That is Nvidia. Stock is up about 0.9%, floating around that $115 per share level. It announced partnerships this week with GM, T-Mobile, quantum computing companies. Really failed to rally on the news, and the stock is on pace for losses this week. But let's take a look, Jay, at the technical setup for Nvidia and bring in one of my favorite terms in the investing world, which which is the death cross.
Yeah, we're hearing a lot about the death cross this week. That is when the 50-day moving average crosses below the 200-day moving average. So a faster moving average goes below that, and that is usually a sell signal. Now, the important thing, as I teach my kids in Technical Analysis 101 at Fordham University, shout out to them, is a lagging indicator. We've seen the death cross before in Nvidia, and it happened in 2022. And what happened? The stock did sell off 45%. Split adjusters went from 20 to 11 and change. If you can pick the bottom on this, great, but it's already down 24% from its peak, so that's what caused the weakness in the 50-day to cross below the 200-day. So to me, it looks like, all right, now we look for the opportunity to buy it. So you want to look for levels of support. The stock is in a near-term downtrend. When you get that buy signal, which is the opposite of the death cross, the golden cross, when the 50-day goes above the 200-day, that is your buy signal. When that happens, that's probably when you want to buy, because we've seen historically in this stock, shares do trend and rally for a significant period of time. That is if we continue to trend. If this stock goes sideways for a little while, you can throw out your crosses because you're going to get negative buy and sell signals continually. But over the last several years, this stock, these signals have said you want to stay away until you get an all clear. So to me, I would look for a deeper sell-off, maybe to the upper 90s if things decelerate. And then you look at the fundamentals. They've been great. This conference went well. Their numbers were solid. So we got to just wait and see how we do with this sell signal.
And I think right now the 200-day is still slightly ascending for Nvidia. So the overall trend is still kind of up, but we were chatting in the last hour, it's been 9 months basically that the stock has kind of gone nowhere, which is not really how the stock has behaved over its long history of booms and busts. Yeah,
we've seen, well, talk about drawdowns. It had 320% corrections last year. It was up 140% for the year.
So in a day this year.
Yeah, I mean, it is historically known to have corrections, but the sideways action that we're seeing is not as constructive as it once was. It does have a little toppiness to it. You want to see it get back above. To me, barometers of health are that average, that 200-day moving average. 45% of the S&P 500 is below the 200-day moving average right now. Not historical lows, but not necessarily healthy. I'd like to see this stock break its near-term downtrend. We didn't get the catalyst this week we were hoping for. So right now, the bears are winning out in this stock. It's going to take some time for it to get back above that average for now.
Stock up a little bit today. All right, let's talk about another hot name in the Mag 7 trade. That, of course, is Tesla. Another name that has seen some sizable drawdowns over its history. Stock up about 0.4 this morning. Jay, give us a little history lesson here for what we've seen from Tesla over the years. We discussed it as we were going through Elon Musk's town hall, kind of rallying the troops. Big drawdowns for Tesla, not anything new for longtime bulls in the name.
No, we went back 5 years, and me and my team back at Freedom, and we looked at it, 40% drawdowns. Over the last 5 years, there have been 6. 2022 was just a lost year. These things, sadly, are normal, and they have crazy headlines. I mean, remember, this goes back before 5 years ago. 420 funding secured, and they were going private, and then there was investigation. We've seen Elon Musk make headlines, buying Twitter. Oh my God, he's spending $44 billion on it. Now he's out of the office a little too often. He got back into work yesterday. It's down 55% from its peak. It has crazy moves, but if you go back to November of 2020, you're at the same spot you are now. So you've seen some undulation in this stock, but it is a trading vehicle. It is not a long-term hold right now, but it's at an area where, okay, risk-reward, it may be on its way back to the upswing. You saw him pay attention and do that town hall yesterday. All he has to do is announce a buyback. He doesn't have to buy back stock. He can announce it, and the shares will probably pop 10%. So who knows with Tesla? But right now, if you were following the fundamentals, the sales, some of the stories going along, it's tough. It's tough to say, I want to jump back in down 55%.
I don't want to break any technician rules here because we had a line chart, not a candlestick chart there. But you look at it, you mentioned it's 5 years, basically flat point to point with plenty of moves in between. We are back now at a level where there are a lot of shareholders, a lot of owners who got in the name at these levels, at about that low 200 to 250, let's call it.
Yep.
So, the technician in me, not a CMT, would say, well, there's some support here. Or maybe it's a moment of truth where people say, no mas, I've seen enough, I want to move on.
Yeah, and as a technician, when I'm looking to buy a stock, I look for a little upward momentum. I'm not going to try to catch the bottom. Catching a falling knife is a dangerous act, and you're going to get burned more often than not. If you catch the bottom, hey, congratulations, you got lucky. What I want to see is some momentum, and the stock is tremendously oversold. Let it get back above 30 on its RSI. The MACD crossover looks like it is about to happen. So there are some signs that we may get some momentum back into this name, and when it moves, it moves.
Yeah.
So we talked about the drawdowns. The upside swings happen fast and furiously, but it's down 9 weeks in a row. It's never happened in its lifetime.
Let someone else do the work for you, and then you can come in and say, all right, I'm happy
like
here.
that.
All right, let's move outside of the Mag 7 for once around here. Let's talk about John Deere. Stock down about 1% today. This is of course, a global industrial ag play. A lot of characteristics that maybe are vulnerable to tariffs here, Jay, but I think a lot of characteristics that in a market we've discussed this hour is getting more defensive. A name that is meeting a lot of the criteria along those guidelines as well.
It's meeting fundamental criteria and technical criteria. I look back over the long term to get a picture. Where has this stock been? It had a nice 2-year base on a weekly chart, and it just broke out. So you have risk-reward parameters set up where, okay, if it gets back below 80, maybe I get out of this trade. But the upside, it's not going to move like a tech stock. It's not going to go euphoric or to the moon as some of these names tend to do when they get momentum behind them. But John Deere, I'm going to quote the CEO, John May. He said, and this is very important because this is where people's mindset is with this administration, 75% of all products that we sell in the United States are assembled here in the United States. So when you're talking about tariffs and you're talking about bringing jobs back, that has got a little patriotic overture. That is something that this administration wants to see. So it's not your sexy name that you're going to want to go to the bar and talk to your friends, oh, I just got into John Deere. But from a risk-reward point of view, from something safe, John Deere right now is a good place to park your money.
And I guess it's interesting now the way that the process for investors kind of has to go in this point in time is think about, is there, let's call it an America bid with any of these names, right? Is there a way that, and we saw it with Apple coming out talking about how much they're going to invest in the US, you've seen it across industries. Companies are looking for ways right now to, whether it's on a conference call, whether it's a one-off announcement, to remind the administration, remind its investor base, we not only have operations in the US, we want to build those operations in the US. It's a very interesting wrinkle inside thinking about, okay, how much money they make in, or how much money they bring in and how much of it do they keep?
Exactly. And when we're talking tariffs, well, if you're mostly based in the United States, then you're going to avoid some of these tariffs. So people will focus on that and they'll skate where the puck is and then focus on these American brands that are, bringing products here, and they don't have to worry about the uncertainty of tariffs that are about to hit them.
Yeah, so maybe makes the negotiation on, hey, we should be exempt from this, that, the other, a little bit easier perhaps. All right, all your market action is straight ahead. Stay tuned here on Yahoo Finance. You're watching Catalysts. All right, let's take a look at shares of Micron. That stock down about 7%. Stock initially rose last night after it reported a strong second quarter. It also issued upbeat guidance driven by robust AI demand. Clearly, the market not loving that story today. Kimberly Forrest joins us now, the founder and chief investment officer at Boca Capital Partners. Jay Woods still with me. So Kim, let's start just talking about the Micron quarter, what you heard from their results. This market clearly is in a more skittish stage, but what did you see from them and how did you think about that in the context of the overall AI trade right now?
Sure. Well, I think they're in the center of the AI trade. They are certainly a company that's participating directly with Nvidia, and their research and development of a new product has really paid off with respect to, kind of a sleepy area of semiconductors, which is DRAM. And it's memory that's on a processing chip. We'll just keep it simple. But, they have fast throughput. It's a product that is expensive to make, and they get paid for it and paid for it handsomely. And again, this is key to processing AI, which demands fast processing. So they are clearly maybe a sole source provider for this, and investors should pay attention. But they're throwing it out with all other AI today, and it's tough being a holder. But I think in time you'll get paid.
Kim, just from a technical perspective, like what are the things right now in your view that are most exciting investors? Because we heard a lot from Nvidia over the last week on what their next generation of chips are going to be. Heard a lot about how much Blackwell demand there is. There was that great graphic that Jensen had, the square pushing the frontier forward, right, with how you can manage the compute and the things that are available on the chip. All this stuff way more about than I do. I'm just curious kind of like what is exciting in this space right now and what is the outlook? We hear, is it quantum or is it some of these just like chip-based processes that can really push forward inference or the ability for these chatbots and all kinds of agentic applications to really accelerate?
So we have pieces and parts of what AI is going to deliver, but we don't have the whole thing. Sorry. I know everybody loves ChatGPT and loves playing with this stuff, but even though I am very much a nerd and I came from software engineering, making AI, I used to have to tell people what AI is. Thank God I don't have to do that anymore. Anyhow, here's the thing, the promise of productivity really is right around the corner. And that's what I'm kind of focused on. The quantum stuff is very far in the future. Sorry, it just is. We're not going to get into why. It's good that it's going forward, but people should be, and especially investors in technology, should be concentrating on where they're going to make money. And that is in delivering these services. Now, what I think the large language models have done really well, it's called natural language processing. We can talk to computers, they can understand us, and we mostly get good results coming back, but that has to improve. But it is a glorious moment here where we are on the cusp of putting these elements together and then being able to be more productive. I pose to you, the productivity is not there yet. And I'm going to tell you that it's really longer than we think, probably 5 years from now. Did I just crush your soul with that information? I hope not.
Hey, Kim, this is Jay. That was great information, but I hear there are two other stocks that you have your eyes on, and one of them struck me as a great safe play in a stock that no one really talks about anymore, which is AT&T. What are your thoughts on AT&T? Is that just a dividend play, or what do you see in there?
No, well, I'm a fundamental analyst, and sometimes I dig way too deep, and this might be one of those times. But not only is AT&T a provider of stuff that ordinary mortal consumers use, which is wireless and fiber to the home and all that kind of, and even old-fashioned telephones. Somebody has to have them. I'm sure they're out there. That's the safe play. But what they really are is one of the providers of the pipelines of the internet. And, they get paid for it. And if we are going to have AI eats up information and demands a pipeline from and to places. And AT&T and actually Verizon is also one of the big players in moving data between cities and between continents. So you have to think about that. And that's why I like it. I don't think we can underestimate the amount of data that we create and get shoved around the world.
I like that someone is finally talking about telephone. And you had one more pick with us before we let you go. Did you want to share that?
Sure. This is a company that the origins are here in Pittsburgh. It began its life as a company called 26, and it used to grow really big crystals to be used in industrial lasers. Does that sound boring? It shouldn't, because what they've done is moved into other areas like they have a lot of military products that they can create and grow. They grow diamond windows, too, that are used in semiconductor equipment, because the chemicals that make semiconductors are super caustic. And a teeny tiny little window for a technician to look at the slurry and what it's doing has to be diamond. Imagine that. But they're really into optical networking. And again, we're talking about miles or millions of miles of optical networking in one data center. And there are a lot of parts that this company provides in lasers. So again, I've dug deep. because I'm not seeing a whole lot of promise up in the area that you and I can touch, software and that kind of stuff, not yet. But I know that this is going to be a thing, AI, and it's going to need this hardware regardless.
All right, Kim, great conversation. A reminder, it is a large market out there with many stocks and many opportunities. All right, Kim Forrest, thanks so much for the time.
Thank you.
All right, coming up, the biggest risks for the Trump economy. Rick Newman joins us next on Catalysts. All right, well, President Trump's shifting economic and tariff policies are fueling economic uncertainty. Yahoo Finance's senior columnist Rick Newman joins us now to talk about some of the biggest risks ahead. Rick, we are less than 2 weeks away from Liberation Day. So how do you look at the main risks to the Trump agenda at this point? And I guess I would follow with, are these self-inflicted in many cases in your view?
I wonder if we're going to make a national holiday out of Liberation Day on April 2nd. For people not in the weeds on this, April 2nd is the day that Trump says he's going to unveil a long list of what he calls reciprocal tariffs. So where he feels that other nations unfairly treat American exports unfairly, he's going to do the same thing to them that they're doing to us. That could be a mixture of new tariffs, quotas, other ways to keep products out. Trump says this is, quote, the big one, as if all the tariffs we've seen imposed so far are just kind of an appetizer. Now, of course, as usual, nobody knows if this is mostly a bluff meant to gain leverage in trade negotiations, or if we're really going to see some sizable tariffs here. But if Trump means it, some analysts think that markets are very unprepared for this. And we could see, tariffs as high as 50% or even 100% on some big product categories. And it's probably going to be the usual mix of a million different things, impossible to keep track of. Some of them go into effect right away. There are negotiations all over the place, hard to keep track. So we don't know. But, I think a big question for markets, Myles, is it just uncertainty that is, kind of keeping stocks depressed, or are we actually seeing losses in the economy? And it's tilting more and more toward we're actually seeing losses in the economy, and that we're losing output, for example, that we're not going to get back. And maybe investors are starting to say, other stock markets are looking pretty good. Germany is up more than the United States. China up more than the United States. Maybe I should go there. So there's a lot going on, and I don't think it's realistic to think that this chaos is going to end anytime soon.
Yeah. So you talked through the reciprocal risks there on the risks for Trump's economy. You talked a little bit about the stock market. Interesting, he doesn't want to talk about it as much, but we'll save that for another conversation. Something else you flag as a risk is layoffs rising, and it really raises, to my mind, the question, the statement of fact that we haven't had an extended cycle of folks losing their jobs in this country since the financial crisis. We had a brief blip during COVID, but it has been multiple presidential administrations since we have seen a kind of grinding job loss. And while economists are not looking for that, it feels like we're inviting, to some extent, some of these challenges into the economy with the uncertainty around tariffs and other things.
I think you put it well, Myles. So, we thought inflation was a thing of the past until 2022. We hadn't had it in 40 years, and suddenly, inflation can be pretty lousy. And, we are a consumption-driven economy, and consumption means people have to have incomes. So there's starting to be some talk in the auto industry, for example, of coming layoffs, because they're just not going to be able to keep up production at the levels that they've had for the last several years. So you lose a few jobs here and you lose a few jobs there. And at what point does that start to hit consumption and lower overall economic growth? And, we've been talking about this a lot on Yahoo Finance. Goldman Sachs and many other forecasters have been downgrading their outlook for economic growth and raising their outlook for inflation. And again, when you lose economic growth, you don't just get it back. It doesn't just come back the next quarter. So if people lose their jobs, they're losing income, they're losing purchasing power. I don't want to be alarmist. Like, this is not necessarily going to snowball into a recession in 6 months. But why would you be doing this in the first place? I mean, you want every 1/10 of a percentage point of economic growth you can get, and you want the unemployment rate to be as low as possible. So this is the pain that Trump and his economic advisors say we might have to go through in order to get whatever this mysterious gain is on the other side. And I'm just not hopeful that this is going to end well.
Well, Rick, just to put you on the spot, I know you're not hopeful. He has been keeping us on our toes this entire time. Is there any part of you that thinks this is just purely a negotiation tactic, or is Liberation Day really going to happen and we need to really pay attention to what happens on this final day?
I mean, go back to the market outlook when Trump took office on January 20. I mean, the prevailing view on Wall Street, without a doubt, is that there's going to be a little bit of additional tariffs, but mostly this is just going to be posturing to get trade negotiations. And very clearly, markets got much more severe tariffs than they anticipated. That was the main reason we got a stock market correction. I mean, remember, stocks did go to record highs during the first 3 weeks Trump was president, and markets at that point, they said, wow, maybe he really means it about tariffs. And we've never heard Trump or his economic guys talk about, we have to detox the economy. We have to have some pain before we have the gain. Mm-hmm. This is a different Trump. So I think that there's this shift in sentiment underway that maybe we need to take Trump more at his word on tariffs and be a little less optimistic that they're just going to be symbolic.
All right, Rick Newman, we'll leave it there, and we'll talk about it all next week ahead of April 2nd.
Bye,
Thanks
guys.
for the time. All right, the Fed is projecting higher inflation and lower growth amid a backdrop of uncertainty. Yahoo Finance's Jennifer Schomburger joins us now for a closer look at Fed commentary over the last week and the shifting policies coming out of the White House.
Good morning, Myles. It's nice to see you in the anchor chair. Uncertainty remains the refrain for Fed officials. Just this morning, New York Fed President John Williams saying in a speech that he is very uncertain about the outlook for the U.S. economy. That speech title was Certain Uncertainty. He says he expects lower growth this year amid a lot of unknowns about the impact of new trade policies, immigration, and fiscal policies. Fed Chair Jay Powell, for his part, said this week that his base case for any higher inflation from tariffs is that it will be transitory. That comment raising a lot of eyebrows this week, reviving memories of the Fed's slow response to inflation coming out of the pandemic, where we saw inflation rise to a 40-year high. All of this raising questions about whether the Fed could make the same mistake again. Mohammed Al-Arian, who's president of Queens College in Cambridge, saying on social media this week, quote, "I would have thought that particularly after the big policy mistake of earlier this decade, and given all the current uncertainties, some Fed officials would show greater humility. It's simply too early to say with any regressive confidence that the inflationary effects will be transitory." Former Treasury Secretary Larry Summers reportedly says he's astonished. Though for his part, Fed Chair Powell did qualify his expectation with uncertainty. Take a listen.
I think that's kind of the base case. But as I said, we really can't know that. We're going to have to see how things actually work out. In real time, as we know, it's hard to make that judgment. And we're well aware of what happened, obviously, with the pandemic inflation.
Treasury Secretary Scott Bessent said earlier this month that he would hope that failed Team Transitory could get back together and think that nothing is more transitory than tariffs. Meanwhile, Wilmington Trust Chief Economist Luke Tilley is one who actually agrees with the Fed chair, saying that he thinks tariffs amount to a significant tax hike and are more likely to weaken consumer spending, ultimately weighing on longer-term inflation. Separately, Myles, this morning we got a statement from Fed Governor Waller on his dissent at this week's policy meeting. He would have preferred to have kept the balance sheet runoff at its current pace rather than dropping that back to $5 billion a month from $25 billion. He thinks he doesn't see any distortions right now in money markets and thinks that reserves remain abundant. Back to you.
And, Jen, I think given all the headline talk about the inflation and growth outlook, we sort of forgot about the QT changes that we saw.
And we did see Treasury yields go down on that, which is something this administration wants.
Yeah, so certainly maybe that'll be the follow-up. We'll worry about QT next week once we get through this one. All right, Jen Schomburger, thanks so much. Great. All right, coming up, what one financial advisor is telling her clients about the sell-off. Back with more on that right after this. All right, this month's stock market sell-off wiping trillions from U.S. equities as recession fears grip Wall Street. So how are financial advisors guiding their clients through this period of volatility? As part of our weekly FA Corner, brought to you by Capital Group, we have Mindy McIntosh, McIntosh & Associates founder and CEO. So Mindy, let's just start with how you've talked through client concerns over the last month, which really saw markets, run from all-time highs, very quickly went into correction. And I think the speed of that move has really unsettled a lot of folks.
It really has. That speed of seeing all what we first saw when the election happened. Then there was fears of what might, currently extend with the new Trump administration. We saw markets actually respond very well. Then now with what we're seeing currently with inflation, interest rates, taxes are always a big talk here with our clients. And just now, as the tariffs come in, we just feel it's imperative to see these tax rates going up. Inflation, I know they're looking to make possibly 2 cuts later this year, but it really helps us to, especially over the past 4 weeks here, reach out to a majority of our clients and actually reduce some of their exposure, look at some alternative actions for them, and really start to ease and make sure that they know where they're currently sitting. And for us, we're so retirement focused. How much time do they actually have until that retirement day hits? And then what is the different changes for our clients that actually truly are already in retirement?
So when you look at that allocation mix, what are the areas outside of just the equity market where I think a lot of people, just because of price appreciation, ended up overweight over the last few years? What are those areas that you're advising folks to rotate into if they're able?
Sure, if they're able. So some of our clients can actually do private equity and do some private placement. We're looking there. We also do some alternative indexing if we want to remove some funds from the market and utilize a bond alternative and even an indexed annuity to help allocate that way and still watch what's happening in PIMCO and S&P funds, but without having to be directly related to the market. We're also truly looking at folks that actually have an opportunity zone with buying into some major professional sports teams if they so have the funding and accredited investor to do so, to make sure that we can have some of these opportunity zones. And even real estate, people need to realize and remember that private real estate is such a great opportunity for some inflationary hedging opportunities that just depending on the portfolio balance, what they can do. But you said it right, we had to reduce kind of some overall heavily weighted accounts, and it's making our clients feel much better if they weren't already in these spaces to make these adjustments to feel a little bit more steady.
Yeah, certainly those Celtics headlines from yesterday, bringing the focus on sports valuations in there. All right, Mindy McIntosh, appreciate the time.
Thank you.
All right, well, starting on Monday, 4 new names will begin trading as a part of the S&P 500. A couple of household names here. We've got DoorDash, TKO Group, you might know them, UFC and other holdings there. Williams-Sonoma, Expand Energy also entering the index. And Jay, I think the action that we see around stocks, usually on the announcement of the inclusion rather than the inclusion itself, is one of my favorite kind of oddities, really, inside of financial markets.
And there's always anticipation. Are we going to get it this time? And I know Coinbase, they were the one left outside the dance this time, and the stock was down as a result of it. But those 4 will be going in at the end of the day. That makes for exciting times down on the floor as a former floor trader for 2 decades. Those closes can be a little crazy. We have expiration today as well. So the last hour of today, last 30 minutes especially, watch the volumes increase dramatically. And maybe, just maybe, we can rally a little bit into this weekend. Maybe the shorts are looking to cover because of uncertainty, and we get a little bit of a rally into this.
So those it's triple witching today, right? So we've got those expiries coming up. I was always curious, it seemed to me, not being on the floor, that you would get sticky action around like just round numbers, where you've got a lot of options expiring, a lot of people looking at these things. Is that how, as you approach these closes on the floor, you could see like, all right, we are eyeing this level, and it's going to be a battleground to see, is this expiring worthless, or are we actually going to hit?
Yeah, people have those targeted goals in mind, and they usually are around round numbers. So yes, look at those stocks that are trading a nickel to a penny, and does it close down to the figure 95 to 99? Will we get that rally? Yeah, but you don't put too much credence into it. You're just focused on the overall trends and things. Those 4 stocks, a little more attention will be paid to that. But overall, no. With the 0-day to expiry options now, you kind of ignore the option activity that may be driving the actual close of the stock.
I know. We could do another hour on the 0-dated options.
We could. I mean, there's so many different things we could do. We didn't even talk about recession and the NBER, who declared declares recession and what that means, and that's another show. But there's so many things to talk.
I was looking for a palate cleanser on the recession talk, so it's good we have a technician in here. We could talk some stocks, talk some shop, talk about the S&P 500 inclusion forcing buyers into those names, and we'll see how they open on Monday. Jay, really appreciate the time. Thanks for stopping by
great to be here.
for the hour, and enjoy the hoops.
I will.
Later today. We're about 80 minutes away from the opening tip. All right, coming up on Wealth after this, which is dedicated to all your personal finance needs, Brad Smith has it for you next here on Yahoo Finance.